Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 108. This one is titled Establishing Our Cost Basis in a Multi-Step Managed Trade. More specifically, we're going to be evaluating a covered call writing trade. And we're going to be using a real-life example with Crane Shares CSI China Internet, which trades on the New York Stock Exchange under the ticker symbol KWEB. Now, frequently over the years, I've been asked questions regarding what cost basis should we be using for our option selling trades. And this could be a little confusing because there are two different perspectives that we could use. One, for making the best possible trading decisions at the time we're executing our trades. And the other is after all the legs of the trades are ultimately closed and establishing how we did in totality, or in other words, if we were trading in non-sheltered accounts, what would be our cost basis for tax purposes? So in this podcast, we're going to be reviewing a real-life trade with KWEB, starting with the initial structuring and going through multiple exit strategies and ultimately closing all legs of the trade. And we'll be putting this in the perspective of what cost basis we should be using. So once again, let's just redefine cost basis. And the first perspective, which is how we're going to start our trade, is the beginning and the trades that we make over the course of managing those trades, because things will change. And the stat that we use to calculate our initial time value returns, along with upside potential and downside protection, is our initial structuring. And that can change over the course of our position management. So that's the beginning. Now, at the very end, what is our cost basis that we use to measure final calculations when all the legs are finally concluded? And again, that would be the cost basis that we'd be using for measuring our capital gains and losses. So let's get this podcast launched with a real-life trade with KWEB, and it's opening a covered call writing trade. We're going to talk about rolling out and up, and we're going to be talking about the mid-contract unwind exit strategy. So all those things are inherent in this real-life example. Now, on June 8th, KWEB was purchased at $56.50. And immediately after that purchase, the 56 in the money call option was sold at $1.65. And that's for the 6/19/20 expiration. So it's really only 11 days out. That was the initial structuring. Now, on 6/19, on expiration Friday, KWEB had moved up from $56.50 to $61, or well higher than that initial $56 strike. So we decided to roll that option out and up. So we bought to close the 56 strike at $5.90. So that included the intrinsic value component plus a small time value component, and then sell the 61 7/19, which is a month out expiration, at $2.90. So we're going to be talking about the calculations in the next few moments. So we initially structured our trade, and then we rolled out and up. Now, on 7/6, what happened was we ended up buying to close that 61 strike at $6.95 as the stock had moved up in price to $67.64. It was just launching itself to the moon. So it went up to $67.64, and the stock was sold at $67.64 after closing that 61 strike at $6.95. So those are all the numbers. Now we're going to kind of make some sense out of this by feeding this information into the BCI calculators, and let's see where we're at. Let's start off with the initial structuring of the trade. For those of you watching this podcast, You're looking at images now of the multiple tab of the BCI covered call writing calculators. And for those of you just listening, I will describe. We have in the blue cells on the left, KWEB trading at 56.50. This is how the trade started. And the 56 call was sold at $1.65. The calculator then tells us that the initial time value return, deducting the intrinsic value, is 2.1%. Remember, that was only an 11-day return. And that's guaranteed as long as the stock does not decline by more than 0.9% or to below that 56 strike by expiration Friday, 11 days away. So what cost basis will we be using now for this initial structuring? Well, we bought the stock at 56.50 and we sold the 56 call for $1.65. Now, when we're figuring out our time value return, or at least our initial time value return, we do not count the intrinsic value of 50 cents, the amount that 56 strike is lower than current market value of 56.50. We do not count it. We deduct that, and the calculator will do this for us from that $1.65. So what happens to it? We received it, but we're not counting it. Well, what we use that 50 cents for is we deduct it from our cost basis. So initially we bought the stock at 56.50 and we sold the 56 call for $1.65. So of that $1.65, 50 cents is intrinsic value. We use that to buy down our cost basis from 56.50 down to 56. So that is our cost basis initiating this in the money covered call. So 56 is the cost basis initiating this trade. Now, on 6/19, expiration Friday, we rolled that strike, that 56 strike out and up. And what is the cost basis we used for that trade? Well, if we didn't roll the option and we allowed assignment, how much would we receive? Our contract obligation of $56. So our comparative basis, as you can see on the spreadsheet, if you're watching this podcast, is $5,600 or $56 a share. That is our cost basis as we roll the option out and up. Because had we not rolled it out and up, that is precisely how much money we would receive if we allowed exercise. And we rolled it out and up, and that would then give us an initial time value return when factoring in the bought up value of the stock, because the stock is no longer worth 56. If we roll out and up, it's now worth 61, the new strike price. So we're gaining $5 per share there. So we factor that in, and when the smoke clears, that results in an initial return of 3.57%. And again, that's a 1 month return because we rolled out from 6/19 to 7/19. Now, that is the first management leg, the rolling out and up. Now, the mid-contract unwind exit strategy on July 6th, because the price of the stock had gone up again to 67.64, so we closed all legs of the trade. So once we closed all legs of the trade, we could then calculate what our cost basis is based on our stock credit or debit plus the option credit or debit. And then we use our cost basis as the initial cost of the shares, in this case, 56.50. So let's figure this all out. We bought the stock at 56.50. We sold it at 67.64. That means our net credit on the stock side of the trade is $11.14 per share. Now, on the option side, where there was a whole lot of action going on here, it's actually minus 830. We sold the initial call 56 at $1.65. We bought it back at $5.90. We resold the 61 at $2.90, and we bought it back at $6.95. Now the net position then, if we take the $11.14 credit and deduct the $8.30 debit, we end up with a $2.84 per share credit. Now, what cost basis do we use? Now that the trade is over, what did we enter the trade? 56.50. And that results, folks, in a 5.03% return. So our cost basis for the final returns is the initial cost of the shares. Let's just summarize this now. Option selling calculations allow us to make the best trading decisions every step of the way. We don't want to cloud what our shares are worth when we're executing and managing our trades. At the very end, after everything is closed, we can then take a step back and look at the totality of all the initial trades and management aspects of the trades. And then we use our original cost basis. So should we roll out or allow assignment? Comparing apples to apples, what are our shares worth? In this case, it was $56, the initial contract obligation. Now, using the Elite Plus calculator, which you could use for both covered call writing and selling cash secured puts, will greatly assist with all of these trading decisions. Now, our cost basis for tax calculations or final results will differ from those that allow us the best trading decisions at every given point along the way. So let's not cloud or confuse our cost basis statistics because one is based on current trading and the other is based on final results. And if we can differentiate between those two, it will make us all much better investors and elevate our returns to much higher levels. As I end all these podcasts, I want to remind everybody about the BCI package, our best and most comprehensive educational product ever produced by the blue-collar investor. Folks, you will need nothing else to master the strategies of covered call writing and selling cash secured puts and all related strategies. It contains 6 online video courses, along with the downloadable workbooks, 6 calculators developed by BCI, so you'll find them nowhere else, 5 of our best-selling books in ebook format, and 13 months our annual premium membership subscription, which includes 4 reports that we produce for our members, along with online training programs. We have over 200 training videos, and we add a new one every single month. Some months we add 2. So all that is part of the BCI package. Again, the Ask Alan Library video only available to premium members. We have Blue Hour in-depth webinar series. There's about 20 of them right now on the member site. And we add at least one every single month. So the online video training is ongoing and never ending. And that's all part of your membership. Where do you find information and how to access the BCI package? Go to our website, www.thebluecollarinvestor.com. Click on the link on the top that says BCI package. We have a video for you and more information, and then the opportunity to make the purchase. So there you have it, folks. BCI podcast number 108. I want to thank you all so much for taking the time to attend and listen to, and in some cases watch this BCI podcast number 108, establishing our cost basis in a multi-step managed trade. Folks, I hope you enjoyed this presentation. And more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.